Baker Hughes has just released its latest quarterly and full-year results, and while headline revenue looks flat, the real story is improving cash flow, record backlog, and strong long-term visibility driven by LNG and power demand. For the fourth quarter, Baker Hughes reported revenue of $7.4 billion, essentially unchanged from last year. Orders, however, were stronger at $7.9 billion, with $4 billion coming from its industrial and energy technology segment. For the full year 2025, revenue came in at $27.7 billion, flat year over year, while total orders increased to $29.6 billion. The standout was industrial and energy technology, which delivered a record $14.9 billion in orders. The most important takeaway for investors is backlog and cash durability. Baker Hughes ended the year with record remaining performance obligations of $35.9 billion. Of this, $32.4 billion came from the IET segment, highlighting strong multi-year project exposure across LNG, turbines, compression systems, power infrastructure, and long-cycle service contracts. Cash generation was a major highlight. The company posted record annual free cash flow of $2.7 billion. In the fourth quarter alone, free cash flow reached $1.34 billion, while operating cash flow was $1.66 billion. Management credited stronger working capital efficiency and customer advance payments. On profitability, results were mixed on a reported basis, but steadier on an adjusted basis. Fourth quarter net income fell to $876 million compared to last year. However, adjusted EBITDA rose 2% to $1.34 billion. For the full year, adjusted EBITDA increased 5% to a record $4.83 billion, driven by productivity gains and operating leverage in the IET business. Operationally, Baker Hughes continues to shift toward gas and industrial energy infrastructure. The IET segment secured multiple LNG-related awards tied to U.S. export projects, along with power system orders linked to grid reliability and growing electricity demand from data centers. At the same time, the oilfield services and equipment segment faced macro-driven softness. Lower activity levels, inflation, and an unfavorable mix weighed on revenue and margins. Despite this, management emphasized disciplined cost control and relative profitability stability. Looking ahead, Baker Hughes expects IET orders to remain strong in 2026, supported by continued LNG momentum and a stronger year for floating production and gas infrastructure. The company guided for mid-single-digit organic adjusted EBITDA growth, with IET margins moving toward a long-term target of 20%, while OFSE is expected to remain relatively flat. Strategically, management described the 2026 to 2028 period as Horizon 2, positioning Baker Hughes as a more industrialized and production-oriented energy company with lower cyclicality and more durable cash flows. Overall, Baker Hughes may not be a high-growth story in the near term, but its record backlog, strong exposure to LNG and power, and improving cash generation make it a long-cycle energy infrastructure play rather than a short-term oil services stock.